Hey everyone, welcome back to the podcast and welcome to 2026. Now, last month we covered a little bit about what 2025 was like and a bit of a recap on the finance and property market. Today, we're going to give you a bit of an outlook as to what 2026 looks like, specifically with regards to the finance outlook. Now, this is not necessarily the most exciting topic, but it is important as it will impact home loans and the property market. So we're going to cover a little bit about interest rates and some changes to lending. So joining me today is Dill. Dill, welcome back.
Thanks for having me. Happy New Year.
You ready to get stuck into it?
Yeah, let's do it.
I guess the first thing to probably talk about, and it always feels like it's a relevant topic, is the RBA and interest rates. It's very important because it ultimately, whatever the RBA does is ultimately what the end borrower is going to end up paying. So what's happening with the RBA and the cash rate?
Yep. So if we look back to 2025, we had 3 rate cuts. So it was welcome news for all homeowners and borrowers. So we saw that throughout 2025. The last meeting in December, everything held as is. I guess if we look back to the commentary from the RBA, it's looking likely that we are at the end of the rate cut cycle, and we will probably move into a holding pattern for 2026. They're kind of sitting on the fence whether there will be a hold or potential rate increases in 2026 as well. So I guess what we'll probably lean on is the inflation data for that. So if those numbers continue to tick up, then we might see a rate increase, or if they sort of get back within that band, we might have a stable position on the cash rate for 2026. So as always, a bit of watch and see with what commentary comes out of the RBA and I guess the economy in general, but something for all borrowers to keep in mind at the moment, because you always want to make sure you're on the best rate and product for what your position is.
I just want to kind of touch on that. And how volatile that can be, because we might have been sitting here as little as 3 or 4 months ago, and all the outlook was suggesting was that the rate cut cycle was going to continue into 2026. And all of a sudden we're down 3 months down the track and we're even potentially thinking about rate rises. So whilst this outlook is really relevant right now, I think it's also important to recognize that it is quite volatile. And it is important to just kind of stay on top of it. But if we assume that it is going to be a holding pattern or a potential even rate increasing environment, what's one thing that borrowers might start considering as we look into 2026?
Yeah, very, very good point. I guess the fixed rate discussion is sort of back in the market now, and borrowers might look to split off their loans and have a portion fixed and a portion variable to, I guess, hedge the market, because as you just mentioned, it is still a bit of an unknown and it can change pretty quickly. Like as we saw in 2025, a lot of the banks were forecasting rate cuts in 2026, and now we're at the start of the year. And that might no longer be the case. So if you do want a bit of certainty with your repayments, then reach out, get in touch with your broker, and then maybe consider a fixed option or a split loan where you get the best of both worlds. So one thing that we'll be monitoring very closely throughout the year.
Absolutely. So the second thing, I guess, is, and we mentioned this before, is in terms of changing rules. A lot of the time that happens at a bank level, which is most relevant, and a lot of the time that actually starts from the bigger players up above them, right? Which is basically APRA. So towards the back end of 2025, APRA announced that they would be limiting banks from certain types of lending. So what are these new restrictions?
Yeah, so the big one is from February 1st, APRA will be restricting the amount of loans. Around about 20% is what they've put out, is for limit the amount of loans at 20% for household debt to income ratios of about 6%. So to put it simply, if your household income is 100,000 and you want to borrow a debt to income ratio of 6%, you're going to borrow about 600 grand. That's a very basic metric, but that's going to start to be implemented from the 1st of February. So if we, I guess, look back and think about what borrowers we're dealing with, if you're borrowing a higher debt to income ratio, the banks sort of deem it slightly riskier. So they want to put a cap on that. Now, some banks might be close to that cap already. Some banks might have plenty of room within that cap. So that's just going to be a watch and see for us to understand where there is wiggle room with the banks direct.
Yeah.
But essentially, it's to limit riskier lending, if you want to put it simply.
Yeah.
So that's something that, if when that does get implemented and you're in that space, you want to know sort of what your absolute upper limit is.
Yeah. So just going back to that example, just so that I guess people can get a clear understanding of what sort of impact this will have. $100,000, a person with $100,000 or a household $100,000 income, their max, and they've got no other debts, roughly, their max lending can only be $600,000, right?
Yeah.
If they fall within that 20% cap. Now, if they had a credit card or a personal loan, that $600,000 amount will decrease. Okay. So that's obviously a very clear impact for borrowers. But is it as big of a problem as what it's being made out to be?
So generally, based on the way the rates have been in the past, if you were looking at that sort of debt to income ratio, I know you're probably not getting to that amount as a homeowner. Where we see it will have the biggest impact is for investors. So generally, when you're an investor, you've already got existing debt and you're taking on some more debt. That's where the debt to incomes will likely get close to 6 or above 6. So we really see it impacting the investor clients compared to your owner-occupier clients. Yeah. So I think if you are someone that is building a property portfolio or has a property portfolio and you want to make changes to your lending, this is something that we have to be mindful of. Yeah. Because I guess what we've seen in the market is investors have been a large portion of not only Perth, but Australia-wide. And now I feel like APRA and the banks want to limit that. So that's where the investors are something where it might impact.
Yeah. I mean, we spoken about it when it first came out. The immediate thing is, this is, but realistically, if we're looking at, just our client base from our perspective, there isn't that many times where it is above
getting to that amount, especially for your homeowners.
Exactly.
And that's pushing the limit, right? So we always want to find that balance, making sure the client's comfortable, making sure they're comfortable with the repayments, and then if they have to stretch, how close are they getting to that 6% most of the time? Not too close,
yeah.
But it's mainly the investor clients where they're pushing that 6%.
And then worst case scenario, a borrower or a client comes to us and they want to apply for finance. They go to a lender. They're above the 6 times debt to income ratio. Is it the end of the world?
There's other options.
Yeah.
There's other options out there. So whilst we deal a lot with the majors and your second tiers, there's also some third tier lending options out there, which a lot of clients will take in and use them because they're able to grow their portfolio using these type of lenders. So not the end of the world, but definitely something that we'll be monitoring come Feb 1.
Cool. I guess the other big one, probably even more topical, is trusts and company lending. There's been some pretty big changes that's impacted the whole market. Can you just kind of talk us through a few of those?
Yeah. So this has been a significant change and somewhat caught most people by surprise. So there's been a large uptake in trust and company lending over the last few years, and especially we've spoken a little about investors, but a lot of investors are looking at it. This all started when Macquarie pulled out of trust and company lending. They were one of the major players in this space. So that was, from the get-go, quite a large change without much notice as well. So
I think it was a
day's notice, where essentially one of the major lenders in this space pulled out. So when there already wasn't an abundance of options in this space. So Macquarie have pulled out. The other one who quickly followed suit, maybe a couple of weeks later, was Commonwealth Bank. They've just changed the requirements to be eligible for trust and company lending. So the way that's worked is they will still do it. However, the client would have had to, or the guarantor, otherwise known, would have had to have a Commonwealth Bank facility for more than 6 months, and obviously with clean repayments. So what they've done there is they said, look, we're still happy to do it, but we want to, I guess, limit the amount of these type of applications we've got to essentially existing clients. So if you don't have a facility with Commonwealth Bank, or if you do and it hasn't been for longer than 6 months, unfortunately, you no longer qualify with them for trust lending. Off the back of that, we've seen other banks turnaround times blow out. Because they don't really have the appetite for it. So they're saying would rather assess a straightforward PAYG application in 1 day, but we'll put 15 business days on trust and company applications.
Yeah.
Push out. The other one is they've increased the pricing or the fees involved with it again. So they don't necessarily want to do it. So we may as well put a high premium on it.
Yeah.
I think there will be more changes coming. And we might see more lenders follow suit and pull out of that lending space as well. So couple big ones have sort of taken a step back. We already had some existing banks offering higher rates and longer turnarounds, but that's sort of blown out even further. But we might expect some other ones to come in and sort of pull out as well. It was all off the back of, I guess, what's called general advice, where people were giving advice to potential borrowers that there was this magic scenario or option for clients where they could borrow unlimited if they were to do trust and company lending, which is not the case and is not in the best interest of the client to advise that. And Macquarie all quoted in saying that.
Finfluencers, I think.
That was the terminology. So
yeah.
Hopefully we're not one of them, but on social media and online, people saying you can do X, Y, and Z if you purchase in a trust or a company. They were quoted in saying that was one of the main reasons why they pulled out. So it has been a big shift. We've seen a lot of our investor clients be using that strategy over the last few years, while still a very effective strategy if getting advice from an accountant or your planner. There is still options out there, but now I think it's more about planning. You need to plan. You need to be prepared. Understand what your options are. If you're getting advice, your accountant's advising you to buy in that structure, make sure you get your lending set up because there is less options now, and it might take a little bit longer to get that approval as well.
Yeah, exactly. And just on the accountant and the financial planners side of things, prior to this becoming a bit of a fad, if we can call it, that structure was recommended to a lot of clients, not just from a borrowing perspective, but other things such as asset protection and whatnot. So whilst there is or has been a lot of changes and is going to be, like you've rightfully pointed out, potentially, it may still be the best way to go for a lot of people. So it shouldn't be looked at as a no, this is a no-go. It's still definitely an option on the table, probably just a little bit harder.
A little bit harder, and just plan. There are still options available, but we just want to make everyone aware that there has been a change with who does offer it, what lenders offer it.
Yeah. Okay. The next one is, I guess, the sort of schemes that the federal government offer. Now, there was a pretty big change last year. I think it was from the 1st of October, the federal government's first home guarantee scheme with a 5% deposit. That had some pretty large changes, which has had an impact on the market, as we've seen. Most recently, towards the back end of 2025, the Help to Buy scheme has come out. Now, that was initially in conversation or became a proposal almost, I think it was 2023, so close to 2 years ago. So that's begun. Talk to us about that.
Yep. So as you said, opened up the back end of 2025, was a Labor, federal Labor government scheme that was introduced or discussed, I think you said, in 2023. Essentially, the slight difference here between the 5% deposit scheme is this one is a Help to Buy scheme that allows a 2%. So less of a contribution up front, but there is definitely some different restrictions and requirements to be eligible for this scheme. The big one being the government essentially guarantees and has ownership in the property you buy. So for example, if you're purchasing an established, it's 30% ownership. If it's a new build, it's 40%. So that's the big difference here. Whereas previously it was a 5%, they were just essentially guaranteeing the 15% to cover or avoid the lender's mortgage insurance.
But no ownership.
No ownership. Whereas this one, Help to Buy, the government will have ownership of your property.
Okay.
So they're the two big key differences there. In terms of the eligibility requirements, as we said, 2% deposit, Australian citizen, earning less than 100,000 if you're a single, and if it's a couple, it's 160,000. So once that is actually a bit of a difference as well. The 5% scheme has no income caps, whereas this Help to Buy does have income caps. You must live in the property as your primary place of residence, not own a home at the moment. However, if you previously had owned a property and you sold it, you might still be eligible. So they're the key requirements that you probably want to keep an eye out for. We'll wait and see how much uptake we get for that. we're still seeing a lot of the 5% scheme, but we'll see what happens.
So I guess just to kind of differentiate for the listeners, it's the 5% scheme is probably more for your higher income earners, where there's less criteria. And then this is probably going to fit people who are looking to get into the market whose income may not be as high, and therefore they can't borrow as much. So then therefore it makes sense for them to only own 70% of a property.
Yep, spot on. And slightly less cash contribution with a 2% deposit up front. So yeah, we'll monitor it. I'm sure there'll be a bit of an uptake in it at some stage, and if anyone thinks they're eligible for it, just reach out and we can talk them through it.
Self-employed, we'll move on to. This one's always an interesting one. There's been a few changes. Can we just discuss a few of those?
Yeah, really important, especially for a lot of our client base being self-employed or a lot of business owners out there, is, policy's always changing in this space. One of the, I guess, big changes we have seen in recent times is more lenders moving towards, your most recent financial statements. Whereas historically, it's always been 2 years, the average, the lower, the higher. A lot of lenders are moving to most recent. So that's a good thing if your business is growing and, you just started out in the last few years and you're growing, your income's, on the improve. That's giving you more lending options. The other key one is some lenders, having a bit more flexibility with regards to how long your ABN has been registered for. Same thing. Stock standard a few years ago would have been 2 years, ABN registration. Once again, that is slightly changed, and there's options out there with shorter registration dates. Just means more options for clients, which is what we want. Especially if you are self-employed, you don't want to be pigeonholed to just certain lenders.
And we've actually spoken about this previously as well, is that, if we wanted something like that, we maybe might have to go to a second or a third tier lender. But with that flexibility, you might actually be able to go to a first tier lender.
Yeah,
so
exactly right, and getting best rates and fees available. So those, whilst they might seem like slight tweaks, they make a big difference, especially if you're starting out in business and your year-on-year growth is there. Being able to lean on your most recent, if it's significantly higher than previous, is going to put you in a good position to borrow. The other big one is the streamlined options. So when we talk streamlined, first, the most common one might be, if you're a business owner and you pay yourself a wage. There's been more and more lenders come into that space where they would essentially just lean on the wages that you pay yourself and exclude everything to do with the company. Yeah. So a few more lenders have come into this space. And then we've got the other one, which is the notice of assessment policy. There's a few players in that space, but that's essentially, once again, the taxable income on your notice of assessment over the last 2 years. The banks will look to use that and exclude anything to do with your companies or your registered ABNs as well. So those couple of options, once again, if you want to look at a bit more of a streamlined approach, are really, really good options for your self-employed customers. In terms of, I guess, the lenders itself, some have shifted away from self-employed, and they're saying our appetite more so lies with PAYG clients, and that's the type of client base they're targeting. So that might simply be they don't want to do self-employed lending, so they've pulled out, or they're offering better terms for PAYG customers, and that might just be better rates and turnarounds. Yeah. Whereas some lenders will do the self-employed, but they will take the 15 to 20 days to assess it. And in this market, unfortunately, you can't wait around for that long. You need to move pretty quickly. So that's where knowing the appetite from the lender and knowing who's going to best suit is going to be really important, because you need that quick turnaround to secure that property or restructure your debt to move forward.
One piece of advice, if you could, for our self-employed customers as we start the new year.
Yep. So start of the new calendar year, generally around this time, if you're self-employed, your FY 24-25 company tax returns will almost start to be due. The reason why this is important is the banks will have cut-off times as to when these will need to be required. So if you are planning on doing something in the first 6 months of the year, I would be saying reach out to your broker, start to discuss that with them, but more importantly, start your tax planning. If you haven't done your FY 24-25s, these will start to be required as we get throughout the calendar year. So just plan ahead for that, because you don't want to be caught out not having your tax returns done, and then you can't apply for finance.
Beautiful. That's all we have time for right now. There was definitely a lot to cover there, Dill, and we're excited to see how this year plays out. So thanks for joining me.
No, thanks for having me.
And thanks to everyone for watching.